Okay, then the next thing is to talk about the parameters of our class now. So hopefully you read that long announcement, and it said you'll have a chapter quiz that is timed. It will typically be 20 minutes. And then you can only take it once, and you can only do it in one setting. So once you start it, you need to have time to finish the whole thing. You can't save it and come back to it later. So just be prepared for that when you do the quiz. And I would do that last after I've done my other 2 assignments. I think if you went through that other quiz that I posted about our parameters of the class, you saw my recommendation to read your material or look at the videos in the learning resources folder. Has everybody had a chance to kind of see where the learning resources folder is? Most of you are saying yes. Okay. Because that's kind of where I know it stinks, but you almost have to like teach yourself with those materials. Besides the videos that I post in this Zoom session that we do, that's where you're really going to be able to learn the chapter content, is those things I post in there. And then do the Learn Smart and the regular assignment, and then the quiz. And we will have an exam over every 2 upcoming chapters. So not after chapter 5, but after chapter 6, we'll have an exam that will also be timed, and it will be very similar to your quiz and homework because it's going to be generated inside of Connect. And so the questions will look familiar. So that may help some of you with exams because it'll be pulled straight from homework questions and from those quiz questions. So, okay. Then, any questions about the online stuff? You guys are so quiet. My plan is to go over a little bit of chapter 5, the high points of it, and to show you a couple of problems from your homework, and then to do a Kahoot quiz. I have not done that before with a Zoom session, so I'm not sure how it'll work. So we'll try it though, right? You guys get to be the guinea pig on that Kahoot quiz through the Zoom session. But let me get to the PowerPoint. And I actually have a couple of students from the 9 o'clock class and with the 10 o'clock. The 9 o'clock class is pretty small. So I am doing one Zoom session for both of those. So some of the stuff I covered this morning will be a repeat for the 10 a.m. class, a little bit of it because we covered it before you left on spring break. But I am going to share my screen with you now. Hopefully, yes. Can you see my slideshow? Most of you said yes, you can. Yes, I got a thumbs up. Awesome, I appreciate that. Okay, so the first main thing, and it will also be on the Kahoot quiz and on your chapter quiz, is that this chapter is about accounts receivables. And with accounts receivables, we're talking about revenue on account, right? You provide a service, just like this first slide says, and you don't get paid right away. So revenue on account is a debit to accounts receivable and a credit to service revenue. But we introduced 3 new contra revenues. I'm gonna go slower once I get there. The 3 new contra revenues that we talked about were sales returns, sales allowances, and sales discounts. So the major difference between the sales return account and the sales allowance is that by definition, a sales allowance account is used when you don't receive the product back. So if you are selling, I can't remember if I used this example in class or not, but if you're selling soccer balls and your client, I purchased the wrong size soccer ball one time on Amazon, and then I went to return it and they said, just keep it. And so they gave me my money back, but I didn't have to return the product. They would debit sales allowance because it's a contra revenue. Remember, your revenue accounts typically have credit balances, but any account that's classified as a contra in that category will have the opposite of the normal. So sales returns, sales allowances, and sales discounts, those three accounts, contra revenues will have a debit balance. They look like an expense. So then the next thing, once you see the journal entry, if somebody's dissatisfied with their product, let me go back a second. Remember the sales allowance is when they don't return the product. So since we're dealing with mainly in our class businesses that provide a service, we don't have a product at all that we're giving out yet. We will talk about businesses that sell products in the next chapter, but right now we've just been talking about businesses that provide a service. So you cannot take back a service, right? Like if I go clean somebody's house and they say, you did a terrible job cleaning my house, but I wouldn't because I'm a really good cleaner. But anyways, if they say you did a terrible job cleaning my house, I want my money back. I can't like return the service, right? Like I can't take back my service. I can't unclean their house. So what I'm going to do is I'm going to debit the allowance account and I'm going to credit cash, or I'm going to credit the accounts receivables if they haven't actually paid me yet, right? So that's what this journal entry is talking about when we had the example in the 10 a.m. class about getting your teeth whitened. I think somebody in that class said they had done that. Yes, it was Callie. It was, I remember. Yes. So then on the next slide, and what we're going to do from your homework, the very first homework question, I'm going to flip over to it in just a second, is when you see these terms, remember 2/10, N30, what those terms represent, because that'll be in the Kahoot quiz today, and it will also be on the first journal entry that you do in your homework. If you see on a bill is also known as an invoice. So if you are either receiving a bill or sending out a bill, it would be titled as an invoice. If you see on the invoice the terms 2/10, N30, does anybody remember what the 2 represents that wants to talk or type? See if I can find the words. 2 represents the percentage of discount, right? If your client pays you within 10 days, that's what the 10. The first place represents the percentage of discount. The second place after the slash represents the days to utilize the discount. So what you're going to see on here is if a client owed $350 and they paid within 10 days, they are not going to pay you the entire $350, right? They're going to only pay you 98% of their bill. The other 2% has to be debited to the sales discount. So it's going to say, I debit cash for the portion that they actually ended up paying because they took advantage of that discount. Right now in this chapter, we are on the side where we are being owed money. We're dealing with accounts receivables this entire chapter. We're providing service and then asking our customers to pay us, right? So when they pay us, that's when we record the discount. Students get confused and they try to put the discount at the time the service is done. But when do you know if you're going to give them this sales discount? You only know you're going to give them the discount when they do what?
Pay in those 10 days.
That's right, when they pay. So on your choices on a test or on any of your homework items, you never want to record the sales discount at the same time that you're recording revenue. That's not the timing of how this happens. What happens is you provide work and you record that as revenue. Then if they pay within the time frame, so once you know the date that they're paying you, that's when you would record a sales discount if they've paid within that time frame, right? Within 10 days. Now it could say 4/20, it could say 5/5. Those numbers don't always have to say 2/10. It's the percentage is always the first number and the number of days to utilize the discount is always the second number. Okay. Then secondly, the N30 means they net, really it's no discount and you have to pay within 30 days. So that was kind of a review. The only other thing I want to say is the net revenue amount. It is on your homework a couple of times. It's always the revenue listed first minus any contra revenues. So then the new stuff for the rest of this chapter has to deal with, I'm going to slip through these slides because I only want to really keep you on here about 30 minutes or so. But the rest of these slides deal with how we account for bad debts. When we know a customer, or because of the length of time an account has been owed to us, when we think we won't collect it. The older a debt becomes, remember we talked about this too in class, the less likely you'll actually receive all of that money, right? So your book talks about how there are two different methods. There's an allowance method and a direct write-off method. We are going to focus on the allowance method. That's also in the Kahoot quiz in a little bit. The allowance method is GAAP approved. Direct write-off is not. Direct write-off is used by smaller companies that don't follow all of the generally accepted accounting principles. So if you're not a publicly traded company, you can follow the direct write-off method. Allowance method is the one we're going to focus on, and it will have two journal entries that you need to learn. The two journal entries that you need to learn are the estimated amount that I think I'm not going to collect. So look on that slide where it says companies are required to estimate future uncollectibles. So when do we always make, you know this answer, hopefully somebody does, and you can just chat it because now I know how to find your chat answer. When do we make adjusting entry? What time of the accounting cycle do we make adjusting entries? Or you can say it out loud, either one.
At the end of the period.
Good. Somebody said end of the period. Excellent. So end of the month, end of the quarter, end of the year. We are going to record a debit to bad debt expense. Let me make sure you're on the same slide as me. Let me go back to this one since it's kind of jumping around. We're going to record a debit to bad debt expense. Do you see that underneath the estimated part down there? It says at the very, very bottom of the slide, increase expenses.
Mm-hmm.
You on the same slide as me? Yes. Okay.
Yeah.
So you're going to debit bad debt expense and you're going to credit a new account. If you've already looked at the homework or at some of the slides, you might have seen this. The account is called allowance for uncollectibles. The allowance for uncollectibles is an asset, but it's a contra asset. And that is something that confuses students in this chapter sometimes, because I just talked about contra revenues and now I'm telling you about a contra asset. They're not the same. The allowance for uncollectibles, hey, do you remember me saying this? All of your contras are, how did I describe them? Do you ever remember me saying this word? Yes, somebody said it. Grace, did you say it?
Yeah.
What did you say?
I think it's mom accounts.
That's okay. Yes. So actually the contras are the baby, right?
Oh, yeah.
And they always have a mama, right?
The
So
account receivable.
That's correct. Yes. The uncollectible, the allowance for uncollectibles is a baby to accounts receivables. The mama is accounts receivables. I never have allowance for uncollectibles if I didn't have accounts receivables, right? Like accounts receivables says somebody owes me money. The allowance account says, but part of that receivables I am not going to collect. Some of those people aren't going to pay me. So that is the baby to accounts receivables, allowance for uncollectibles. All of your contra revenues are babies to the real revenue, right? To sales revenue, to earned revenue. That mama has a lot of babies. Okay, so real quick then. After you estimate your bad debt expense, and the way we're going to do it, hopefully you're on a slide that says percentage of accounts receivables. That's the method we're going to use. I'm not going to make you learn the aging method that is discussed in the chapter, but I won't test you over the aging method. The estimate will just always be a percentage of accounts receivables. So if your accounts receivable balance is $100,000 and your company thinks they are not going to collect 5%, you just got to multiply 5% by 100,000 to find out. Now this is key. This is really important. To find out how much you want the balance to be in the allowance account. So let me say that one more time, and then we'll work on a problem. Accounts receivables, if the balance were $100,000 and you thought 5% of that was not collectible, you would multiply 5% by 100,000. But that will tell you the amount you want your accounts receivable or your uncollectible to end up equaling. Okay, so let's see here. Let's stop this share for a second. And I have some problems I want to cover. And let's just do that one real quick. Chapter 5 problems. Let's discuss the 2 journal entries because I haven't covered one of them yet. And I'm going to try this again. Yes, with my whiteboard. You see my whiteboard now? Okay. If your problem, and I believe this is question 4 on the homework, maybe 4 and 5 possibly. It's either 3 and 4 or 4 and 5. So when it says that it wants you, your numbers will be different, remember? When it says it wants you to record the estimate, right? You see this keyword here, estimate, of 30% for the uncollectible accounts. You are going to, that keyword, estimate, means adjusting entry. So you are going to, at the end of the month, quarter, or year, I'm just going to make it the end of, I don't know what year it says. It doesn't say, it just says year 1. So let's make it year 2020. You are going to debit bad debt expense. Remember, a lot of your adjusting entries debit an expense account, and I'm going to debit bad debt expense for 30% of the accounts receivable balance. Right now, it says that the company provided $140,000 on account, but they have collected $100,000. So what is the accounts receivable balance? Anybody?
$40,000.
Yes, 40,000. That is correct. So you take what was owed to you, and then you subtract the cash you've received. So I'm not going to record 40,000 down here. I'm going to take 30% of 40,000. Let me type that. Ooh, I can do that math in my head. $12,000, right? Good job. And then we are going to credit on this journal entry the allowance for uncollectible account, which is a contra asset. Any questions on that first entry? Try to check my chat here. Next, when you write off, this is new, I haven't discussed this yet. Actually, before I move on, I want to say this real quick. Does anybody know what's actually happening to the accounting equation whenever we record this entry? This adjustment?
Are the assets and equity going down? Both of them.
Very good. Yes, I heard a couple of people say assets and equity are both going down. That is right, because expenses always are a part. Remember, E for expense, E for equity. I'm not touching liabilities, so those are untouched, but the contra asset is a negative. Remember, it's like a bad asset, but in a bad way, not in a good bad asset, but it's a bad asset. So it always decreases. That contra asset down there decreases assets. Next, when I actually have to write something off. So in year 2, it says the company writes off uncollectibles. What it means is that I'm no longer estimating the amount that I don't think I'll receive. I am actually saying I will never get paid from these certain clients. So when I made this estimate up here of 30%, it was based on all of the account balances owed to me. When I write something off, when I do a write-off entry, I am saying a specific client. So I'm going to pick on Calvin because I don't think he would ever do this. If Calvin went to jail, right? He got caught sniffing too many markers. And so once he went to jail, I got a letter that said, he's never going to be able to pay you the money that he owes you. So I write off a specific account. It's a certain client. It's not just, oh, I'm taking off these amounts from my accounts receivables. No, it's a certain client or clients that you have decided to say they no longer owe you. When you do the write-off entry, you take it out of that allowance or uncollectible. So what you're doing there is you're actually debiting an asset, right? It's a contra asset, but you're debiting it. So you're increasing assets there. And you credit accounts receivables with the specific, it's not going to have it in your homework, but I would really say the client's name in real life. Like I would take it off my books as being owed to me. Does that make sense? So now the final thing on this is, do you understand what that write-off entry is doing to the accounting equation? Because this one can get a little tricky, but not for my smart class. Any guesses what's happening on this second journal entry? See if I can move this up so you can see it. Yeah. Hey, let's say this. What kind of account is allowance for uncollectible?
Contra asset.
Good, contra asset. What kind of account is accounts receivable?
Asset.
Asset, good. So they're actually both still assets, right? So what has happened here is total assets stay the same. It's really nothing happening to liabilities, nothing happening to equity. One asset increased and one asset decreased. And that is why we like the allowance method, because we're not afraid to write it off. We made that estimate entry back at the end of last year. Oh, you guys, you're going to love this. Are you ready for this? Oh, can you see me or not?
Yes.
Yes.
Okay, so first we provided services on account, right? Revenue. But some of those accounts receivables, we don't think we're actually going to collect. So at the end of the year, in the same month, quarter, or year, we record bad debt expense, because there's a relationship between this bad debt expense that we recorded back up here, the 12,000, and the revenue from that current year. We have to do that bad debt expense in the same month, quarter, or year. And so the effect, right, we wrote up here, the effect is that assets decreased and equity decreased in the right period, in the right year that I recorded revenue. So then when I have to go and write something off, there's no effect of it. It's no big deal. Now, you're going to see on your homework that sometimes the estimate, and like on this entry, doesn't match the actual amount I had to write off. What I thought I was going to write off didn't match. That's okay. Sometimes the estimate is bigger or smaller, right? So in this entry that we just did, this example, you estimated $12,000 was going to be uncollectible. You actually wrote off $10,800. So what is left in the allowance account? What is the balance in the allowance account?
1,200.
I think somebody said 1,200, yes?
Yeah.
Okay. And it is a debit or a credit balance?
A debit.
Say a different one.
Credit.
Okay, she said credit. Yes, yes, yes. Okay. Because look, we credited allowance for 12 and we debited it for 10, not 8, right? So it was still a credit left over in there. So get this. On your homework, when you see that there is already a credit balance in that account, it means you don't have to make as big of an entry. You're going to subtract that credit balance when you go to do an entry next year, right? Because I'm going to make an entry again at the end of 12/31/2021, right? I will do another adjusting entry at the end of 2021. But let's take it like this. If the balance of my accounts receivables was 40,000 and I estimated that 20%, change it to 20%, was uncollectible, I'd be really saying that I need that balance to end up being $8,000, right? I will not make an adjusting entry for $8,000. I will make an adjusting entry for $8,000 minus 1,200. I would only have to put 6,800 into that account. Because remember what I said before, this percentage up here is telling me what I want the balance to end up being. So this example I first did assumed that there was a 0 balance in the allowance account. If there's already a balance in there and it's a credit, you have to subtract that from your percentage that you first calculate, right? What if there's a debit balance in the allowance account?
You have to add.
You have to add, that is correct. You have to add it. What would the debit balance actually be saying? Anybody? No? If I had a debit balance left in that allowance account? It would be saying you didn't put enough in last time. This credit balance said we put too much in, right? And so the next entry gets to be smaller. If there's a debit balance in that allowance account, it means we didn't put enough in. Now I'm running out of time because I don't want to keep you on here forever. So I'm gonna, let's see, hopefully stop this share and see if everybody was in or not, but is it showing you the question? There we go. What kind of account is sales returns? Sales returns. Maybe I should have made the time shorter. 30 seconds is a long time. Okay, a lot of you got it right, and you were on the right track if you chose contra, but contra revenue is correct. What account, do you remember? Well, I'll tell you at the end. The one that is the contra asset is the allowance for uncollectible. Oh no, there we go, okay. Oh, Kirsten, little quickie there. How do I get rid of this thing? Oh, I got an idea, you guys, okay. There we go, now I got it. Now I'm with it. Here's your terms. What does the 15 represent? Oh man, we did not do great on that one. Okay, so the 3 represents the percentage of discount. The 15 is the days to utilize, that yellow one. And then the 30 would be the days till payment is due. And no one chose the green one, so that's good because that's never an answer. Oh, Gracie, moving on up. True or false? The direct write-off method is GAAP approved. The direct write-off method is GAAP approved. Oh man, that is false. And so I tricked you on that one, huh? The allowance method is the one that is GAAP approved. Now, I know it's confusing because direct write-off sounds like a write-off entry, but they're two different things. The direct write-off method is something different from the write-off entry, a journal entry, okay? So the allowance method is the GAP approved one. Oh, Dan, he's on fire. We only have 3 more questions. When you estimate the amount of uncollectibles, what is debited? What do you debit when you estimate the uncollectible? This circus picture has nothing to do with this, but I put it on there. Bad debt expense is the estimate. We're going to debit the expense account when we estimate, when we adjust. We would credit, oh, Kirsten, you're losing first place. Next question. What's the normal balance of the allowance for uncollectible? Allowance for uncollectible. Good, that's excellent. Remember, we never want to pick positive or negative on those phrasings of normal balances. Allowance for uncollectible is an asset, but remember it's a contra asset, so it's going to have a credit balance. And the last question,
Oh,
Kirsten pulled in the lead. Under the allowance method, when you write off bad debt, what happens to your total assets? When you do the write-off entry, what happens to your total assets? When you write something off. That raccoon is staring into my soul. Total assets, good, excellent, nice work. Who's the winner? Show me the podium. Dan, good job. I like how it bounced, that was good. Gracie, and it must be Kirsten, she was up there. Oh, look at that spotlight. Good job. I'll have to, I don't know, send her a bonus point or something. Okay, any questions? Nope. All right, check your announcements and email for an update on when the next Zoom session is, and always email me if you have questions. Please, please, please email me. Okay, I'm glad to see your faces. I'll talk to you later. Bye.